Wow, it's December 11th. Scott Riley, the market update desk and Mortgage One. It's CPI day. So CPI came in just a hair over expected, and we're going to go into why that did it, why that came in where it did, and the curveball the Bureau of Labor and Statistics gave us with a non explainable number. So on the heels of the report, all the futures for the NAS, S&P, and Dow were up, and they opened the trading day all up across the board on all three indices. Now, the November CPI report came in just a tick above the expectations, which was flat. So it came in at 0.1% higher year over year. I'm sorry, month over month, and year over year fell from 3.2 to 3.1%. We were wondering if we were going to get a two handle on it, but we didn't quite get there. The core rate, which strips out the volatile food and energy prices, showed us an increase of 0.3% month over month, which was in line, and brought us to 4% even year over year. Technically, it rounded up to 4%. We were just a hair under 4%, and one category again kept us out of a three handle on core inflation. So, energy prices. This is a big benefit that we've been having over the last 6 to 8 weeks. Declined 2.3%, with gasoline prices falling 6%. Used car prices, though, threw us this weird curveball. Remember, we had been reporting that Manheim and Car Gurus have been showing a decrease in used car prices, but the Bureau of Labor and Statistics within the CPI report showed an increase of 1.6% month over month. Now, this is very odd considering the two other reports, which are real time and potentially more accurate. On the heels of this, the BLS actually came out within the report and said that they're going to change their reporting methodology and calculation starting next month. What does that tell you? Yeah, there was an oops here that kept us from being better than expected on CPI. Now, shelter costs, which take up about 40% of the core index, rose 0.4% and has been cooling now. Year over year, we're up 6.5% versus what we were previous month, 6.7%. Rents rose 0.5% last month and are now up 6.9% year over year, which is down from 7.2% in the previous report. One of the important ones we were looking at, owner's equivalent rent, which tries to capture as best it can the increase in homeownership costs, rose 0.5% and is now up 6.7% from 6.8% year over year. The volatile lodging away from home figure fell 0.9% and helped us a lot within the CPI report. Rents now should start to come under 0.5% as we've been seeing real-time rentals cool off. By the way, but we may have to wait until probably the May report to see large decreases within this, which is going to help us significantly within the inflation report. One category that continues to be a thorn on our side, my insurance buddies are going to appreciate this, motor vehicle insurance. Yep, you guessed it. This makes up 3.6% of the entire report, rose 1% month over month, continues to work against us. This has been impacted by natural disasters, floodings, car theft, which, by the way, is at a 15-year high. These are things to keep in mind. The Fed cannot change no matter what they make the interest rate. They can't change theft rate and Mother Nature. Health insurance rose because of a new way they're calculating it, 1.1%. Overall, not a bad report. If it wasn't for the used car report, we'd be in really good shape, pretty much exactly what we forecasted. So tomorrow we get the PPI, or the wholesale version of inflation. Now we're expecting the all-in headline to decline from 1.3 to 1%, and the core rate to decline from 2.4 to 2.2%. We're replacing a high number from last year with what should be a good number this year. We're expecting this is going to be a big rally to the bond market. Mortgage-backed securities continue to hold on to this channel going downward. going upward. So that we're really close to breaking out on the top side of this channel. Let's hope that tomorrow's PPI report, the Q&A from the Fed Reserve, and their magic dot plot chart helps us out. Today, we're seeing mortgage-backed securities up about 9 basis points. 10-year Treasury is down 1 basis point, so we're holding on steady in the face of just a touch hotter than expected inflation news. But I think the traders are looking at the in-depth information like we did, interpreting it that it really wasn't a bad report, and are anxious to see what the PPI report does tomorrow, and to see if Chairman Powell really jawbones the market, or if he comes out and gives a neutral stance on Fed policy. The market is still baking in over a 35% chance of a March rate decrease. Let's hold on and see what it gives us. As we've been talking, let's buyers ride the wave, get in place to start buying right now. Don't be hit by the tsunami of buyers coming on the market in the next 2 to 4 weeks. Give us a call, 616-293-2189. Have a great day.